come spend a little bit of time with us and maybe learn something that you haven't learned before or heard before. This is actually an event that we do at least once a year or so because divergence has become such an important part of what we do in our bunt trading. Um, we we started developing this trading style, this trading system. Some background rumbling. How's that? Is that better? That was wind. Sorry about that. I've had that on before and nobody's ever said anything. Okay. So anyway, you may have through your, the growth of your trading career, through your journeys of trying to learn, you may have run across divergence and listened to people talk about divergence, and even maybe found some divergence indicators, but found that maybe divergence was a little bit too difficult to try to include in your trading because there are so many different ways to read the divergence and to um, quantify divergence that they can get very confusing. So we're going to try to clear some of that up for you. And rather than sending you through the divergence maze, we're just going to go right around it and try to make it a lot more simple for you to understand. All right, first of all, most of you know me. I've been around a long time. I was a remodeling contractor for over 20 years. Did that very successfully, but as you know, or may or may not know, but most people know that being a contractor is probably one of the hardest, most stressful jobs out there because you're constantly dealing with problems. And, whether it be on your crew or your customers or your insurance or payroll taxes or subcontractors and scheduling. And, there's just so many things that can go wrong, and they usually do. And so I was able to do it very successfully and happily for many years, but I was always thinking there's a better way. There's got to be a better way, and I shouldn't have to get up at 6 in the morning every morning to get everything ready for the crews that came in at 7, and then be out on the job site all day and then out doing estimates all night. It has to be something better. So I found trading, and I thought, well, this could do it. This could certainly, be the ticket for me. I don't have all those other headaches. All I have to do is learn how to trade and sit down in the morning for a few hours and push the button and make a bunch of money and replace the income that took me over 20 years to get to in the construction business. Well, that worked out as well for me as it does for most people, I think. And I struggled and struggled and lost a whole lot of money. And then something really big happened. And we can talk about that more in another venue or this weekend on Saturday. We're going to have another event on Saturday. Since then, I've been a full-time trader. I guess I need to update this. It's probably been more than 9 years now. And I became a trading educator and developing this system that we use now called bunt trading and all the indicators that go along with it, just to make what I was doing much easier to understand and to trade without having to know and understand all the nuts and bolts of what goes into a trading system. Now, I mentioned tomorrow Saturday, we're going to basically have a part 2. And I'm going to, if you registered for this event, then you're already registered for Saturday. So you don't have to register again. If you're watching this on video and you did not register for today's event, then you will need to go ahead and get signed up. Yep. So go ahead and do that. Now today, we're going to talk about the nuts and bolts, the internal workings of why things do the way they do and why they're important in not just in our trading, but in trading in general. And so that we can take that information, and then on Saturday, we're going to take that and I'm going to show you how to use that information and apply it to your trading. Okay, so basically the inner workings and why all of the inner workings work, and then on Saturday we're going to take them and show you how to use them. All right, so it's Saturday, and it's usually one of our more popular events because I will spend a lot of time, as much time as you need, answering questions, showing you different trade setups, how to trade them, what I do, what other traders do, talking about your risk tolerance levels and whether you want to trade our trade system very conservatively or very aggressively. You can do either depending on what you like. So we're going to talk about that on Saturday. So please make sure you attend. It's basically a second parter. Today's the warm-up and Saturday is the second part of the event. So just so that we're all clear, if you don't know what divergence is and why we talk about divergence, here's a definition of divergence. So we're looking at when a price of an asset and an indicator or index or other asset move in an opposite directions of each other. So we usually use that to help us make decisions as it relates to placing or exiting a trade. Okay. So we're looking for things that usually move together that stop moving together. Okay, so they get out of sync with each other. Yes, if you're registered for this, and obviously you are if you're here, then you're also registered for Saturday, and anybody that's registered will automatically get an email with the replay in it. Okay. Excuse me. I've been actually sick for 2 weeks, so I'm finally on the mend, but I still have a little bit of a cough left over, so I'll apologize to you for that ahead of time. I may be coughing, and I don't even, I've been coughing for 2 weeks, so a lot of times I don't even know I'm coughing. Another little piece of housekeeping here. I'm going to cover up the chat because I tend to get distracted when I see the chat. And Lisa and Connor and Praveen are here to answer your questions, as well as many of our other traders are here that can help to answer your questions. If you have something specifically for me, just wait until the end and then ask me then. I'll uncover the chat. But for now, everything's covered, the chat's covered, and I'll look to my associates to answer your questions if you have any in the chat. Okay, so Investopedia uses a little bit different. Divergence is considered either positive or negative, both of which are signals in major shifts in direction of the price. Okay, so positive divergence is bullish. Okay, usually that's going to foretell that price is going to go up, whereas negative would be the opposite. Okay, now there are different ways of reading divergence, but we need something to happen for divergence to take place, right? So for us to be able to trade it, we need for a price, which is, we use price, to diverge from something. And for us, the strongest thing to diverge from, to have price diverge from, is the momentum of the markets, okay? The momentum of price, okay? So not just price itself, but the momentum of price. And that would be over the last X number of bars. So on the left, you'll see where we have increased buying momentum and decreased selling momentum. And conversely, on the right, you'll see the decreasing in the buying momentum and an increasing in the selling momentum. Okay, this is really important And I'm going to show you why. Now, there are lots of ways for us to measure momentum. Okay. There are any number of algorithms out there for, I could probably list 15 or so different ways of measuring measuring momentum. And I've looked at most all of them, but none of them are as good as, say, the top 5 or 6 of them. And so the top 5 or 6 are the ones that we generally look at. Now, one of them is the RSI, or the Relative Strength Index, and so here is an algorithm used. We're going to actually take a look at the indicator called momentum. It's an oscillator, and I'm going to look at this one because it's got the most simple algorithm. But essentially, they're all plotting points on an oscillator. Okay, so this formula is for a single point. That's what this calculation does. So here's what's happening when we're calculating momentum. And this is important. Remember, because we have to measure the current price and the price X bars back to the current momentum and the momentum X bars back. Okay? So this is important, how this is calculated, or at least it's important to some people. On Saturday, we're going to assume that none of this is important to you and you just want to know how to trade it. Okay, but today we're going to give you a little bit of background information. There's all kinds of different people that want different kinds and amounts of information. So we're going to try to appeal to both. Using the car analogy, you know, there are people that won't buy a car unless they know that it has a double overhead cam and anti-lock brakes and how those work and why they work and why it's important, and you know, all of these things that you see in car commercials, and they're talking and they're saying all of these rack and pinion steering. That used to be a thing. It's probably not a thing anymore. You know, all these things that they say, and we hear it on the commercial and we go, well, that sounds like important stuff, but we don't even know what it means. To my wife, a car goes with gasoline and a key, right? That's all that it takes to make a car go. Other people need more and better information to make a decision on a car, on whether they want to buy that car or not. So that's what we're going to be doing a bit today, and then Saturday will be the key and gasoline for how to drive that car. All right, so we're going to calculate momentum based on the momentum oscillator algorithm. And that algorithm says that we're going to take the high of this bar, or the close of this bar, which is right here, and then we're going to go back 10 bars, and we're going to take the close of this bar, and we're going to subtract one from the other. Okay, so the close of this bar was 94.40. The close of this bar was 94.33. That's going to get us a plus 0.07. Plus 0.07 happens to be a point on a graph. Okay? Now, let's move ahead another bar. Let's take the close of this red bar and the close of this red bar. Just coincidental that they're both red. And we've got 94.36, and we're going to subtract 94.30. That gives us plus 0.06. That's another point on the graph, okay? Now, let's move up a bit. Let's take the close of this bar, the close of this bar 10 bars back, subtract one from the other. We have a plus 0.06. So we can see that momentum is continuing up. All right, so because we keep being in these positive numbers, but eventually it starts to turn over. We have the close of this bar and the close of the bar 10 bars back. Subtract one from the other, we get a negative 0.04. Okay, so now we can keep doing this on and on and on and on, and eventually we're going to have enough points to where we can create an oscillator or a graph. Okay, and everybody's seen these on the bottom of your charts, right? When you put on an oscillator, an RSI is a good example, relative strength index. You can see how this happens. So with these oscillators, we're going to create peaks, just like we are in price. So you can see that divergence actually happens when these peaks don't match up anymore. Okay, so we have a higher high swing high. Okay, so we're setting a higher swing high, and we're setting a lower swing high. This is the swing high, but it's lower than the previous one, or vice versa. Okay, so this gives us a divergent condition. Here's what I have found to be the best measurements of momentum as it relates to what we do. We like to use these in a trade room. We use the RSI a lot. The CCI is really good. The MACD is really good. We like to use that one. Stochastics is generally pretty good. A lot of people like to use stochastics. And then there are some others that work really well. Now, we do have an indicator that has all of them in it, and I'll show you that in a minute. So let me give you a kind of a bit more maybe simplified example of why and how this happens. So let's say this is again simplified. Let's say this is a chart, and I know this isn't a trading chart, but this is just for an analogy here, or an example, so that you understand. And this is price, and you know, price comes down and price comes up, and so that's the movement of price. Okay. Now, let's say we have a momentum oscillator that's doing the exact same thing as price. Okay. Now, this is what's most typical. Price and momentum generally move together. Okay. So we're going to have this equal magnitude of change over the last X number of bars. And at any point along this line, these lines are going to agree with each other. Okay. This line's going up here. It's going up here. It's going up here. It's going up here. See how they're in agreement with each other? Pretty much anywhere along the slope. Now, let's take another look at this. And notice when price and momentum get out of sync with each other. Notice that now not everywhere along the slope of these lines are they in agreement. If you just did a quick glance, and here's why a lot of people fail at reading divergence, because they may not notice this shift where they're slightly out of sync. It takes a lot of time to train yourself to see divergence, looking at price and an oscillator. All right, so here's an example. You can quickly look at this. Just at a glance, you may miss divergence here. You may not see it. You may have to study it for a while, and by the time you figured it out, it may be too late. All right, so let's look at this. So we've got price kind of dropping down here, just kind of chopping around, not doing anything. See, it's dropping. Momentum's dropping down here. We had a nice drop here. We have a nice drop here. It pops up again. Just kind of humps over, drops again, humps over, drops again, comes up and drops again. So pretty much everything looks fine, right? So we can say, no, price is setting a lower low. Momentum is setting a lower low. No, price is setting a higher high. Momentum or lower high. Momentum is setting a lower high. Yeah, I don't see. Oh, wait, bam. Notice that momentum is setting a higher low, but price is setting a lower low. That tells us right there that we have a divergent condition. And here's the most important thing that you're going to learn today. When momentum turns before price, price will typically follow. I say typically, I'm going to say almost always, but not always, because nothing always happens in trading, right? That would be too easy. So if you trace these images this with your eyes, um, you'll notice it's very difficult to see divergences. So we end up putting indicators on to try to read divergence, so make it easier for us, right? Anybody ever use these divergence indicators? This is where I started with trying to read divergence, and the most frustrating thing to me was that these lines will usually draw several bars after divergence was identified or after it occurred, and then they always draw backwards. But there are, so many different ways. It becomes very confusing, right? And a lot of people get very confused with having to try to learn all of this to read divergence and learn how to use divergence just to learn how to use it in their trading. And it requires an awful lot of effort. Now, here's the problem that we all have. It requires an awful lot of effort, and we're not exactly sure whether the effort is worth it or not. So we may not put a lot of effort into it, in which case divergence then becomes that thing that you tried a long time ago and it just doesn't work, or it's not for me, or it's too complicated, or whatever. And you put it on the shelf or just forget about it. It can be very confusing. There's a lot of different ways to calculate divergence. There's a lot of different definitions of divergence or algorithms that are used, or how many bars back you're going to count back, or what your look back is, or what's considered a swing high or swing low over what period of time. Indicators or combinations of indicators, whether you're using classic patterns or hidden patterns, and it's very difficult to see it on the fly, right? And here's the biggest problem I had when I was trying to learn to trade divergence, and again, I didn't stick with it probably as long as I should have, because it was too complicated. But when I was trying to do it, I would get into a trade, and because you know how you feel when you get in a trade, you're not sure if you're doing anything right, and you go, oh shoot, I'm just going to get in. You don't have a lot of confidence. Well, now you're in the trade and now I'm sitting there and I'm studying those divergence lines. I'm like, oh, I misread it. Oh, that wasn't divergence. Oh, I made a mistake, or whatever. You're never quite sure you did it right. Now, take a look at this chart. This chart is showing divergence. So this is very typical, and you may be using all of these oscillators to find divergence. This is what we use to find divergence. This is the same chart showing the same divergence signals from the RSI oscillator. Now these signals show up. I'll show you a video here in a minute. These signals, these little lightning bolts, show up on the open of this bar. Okay? So immediately on the open of this bar, we're going to know if we have divergence or not. This is using the MACD oscillator. This is our McDiver indicator. The previous one was our flash. And now this is the one that I told you about. The McDiver and the flash, those two divergence indicators work so well that I took the same algorithm that we use for those and then applied those other oscillators. So we now have what we call our super D, or super divergence indicators, that'll tell us when multiple momentum oscillators are suggesting that we have a divergent condition between price and momentum. It's cool. Cool indicator. All right, so trading divergence. We're going to talk about this a whole lot more on Saturday. But just for a quick reference, it's going to look like that. I think we have some visitors that were visiting with us in the trade room today. Who was anybody here that was in the trade room today? I talked about this in the trade room today. How we see this exact thing over and over and over again. This is not something that I cherry picked. This is a speed flash trade setup. I have a speed tick on this bar and a flash on the open of this bar. This is where I shorted it. Okay, and it happens over and over and over again. Now, you see this. Yeah, Greg, I actually uncovered that so I could see how many of you guys were still here. Yes, it works on futures. This is what we trade. We trade 1 minute charts, but they work on any time frame. And tick charts as well. Yep. So just because we have divergent doesn't necessarily mean price is going to change directions. Okay. We also end up having lots of divergence in choppy conditions. And you think about that. If we have no real strong flow or push in the markets and prices just drifting around, well, momentum will too. It'll be like two lazy rivers just kind of drifting around with no strength behind it. So under those circumstances, of course, you're going to get a lot of divergence. We're going to have some push in the market, some momentum, some velocity, some volatility, some volume in the markets in order for the indicators to make sense. So we don't trade just because an indicator pops up on the screen. The indicator, all of our indicators, simply tell us that a condition exists. Does not tell us that we're supposed to be trading at that time. You'll notice all of we call them our heads-up display indicators. And these are all, we consider them non-correlated, meaning that they all get their data from different sources. So we use divergence for the data. We use momentum, exhaustion. We do some volume spread analysis, some tape reading, and some relative order flow. How do we do that? Well, we have, we want to, the very first thing in the qualifying process for a trade setup for us, before we start applying or anticipating divergence, like I said, is we're looking for some momentum in the market, some push, some velocity. So we're looking for a high potential for exhaustion. This means that price has moved pretty far relatively, and fast, which creates apprehension and fear. It also causes people to start cashing out, and it causes bargain shoppers to start jumping in. Okay? So this is our velocity indicator, this little shadow that you see in the background. So, and this is our momentum indicator. We call it momentum. It's a little bit different than the momentum oscillator. We didn't used to have this momentum indicator, but a lot of people forgot to look for momentum. They would start taking trades without actually seeing that price has moved a long way. So we developed these two indicators to make it so obvious that it just smacks them in the face. So then we've got a potential for exhaustion, and exhaustion sets in. All right, so that's what we're looking for, exhaustion. Now we know that momentum cannot be sustained indefinitely, right? Price always needs to slow down and then ultimately reverse at some point and some amount. That's the one thing that we know for sure about trends. And that is that inside every trend, there are areas where price becomes exhausted, people start cashing out, bargain shoppers start jumping in. Okay, you see it all the time. Look at any chart. Now, we're looking for when the conditions exist just before the people start, all this stuff starts happening. So the conditions are gonna be exhaustion setting in. We can also read exhaustion by looking for price to be overbought or oversold. And again, we like to use the RSI for this. Oops, what happened? So you'll notice overbought and oversold. If you're not familiar with that, there are two extremes on momentum oscillators. There's also usually a midline. But when price crosses beyond these extremes or outside of these extremes, you can say that price is either overbought or oversold. Now, instead of having to read an oscillator for that, we actually take this information and we only give you what we need, and we just put it right here on this current bar, and that way we don't even need this oscillator on our charts. So we can see that using the RSI, here we're overbought, here we're oversold. Okay, so we know we have a good strong potential for exhaustion. This would also be a great place to be looking for divergence. When we know that price has moved a long way and that price is pushing, but momentum, even though price is going up, momentum has shifted. That's the key. Okay, that's what we're looking for. Now we have a number of other indicators to help us with this. We're looking at not just order flow inside every bar. We're looking for the right kind of order flow. Okay, we're going to use volume spread analysis, and we're going to measure the weaknesses and strengths inside that individual bar. Okay, we're going to also look at background strength and weaknesses. So we always have to look out for weakness in an uptrend and for strength in a downtrend. Okay. It used to be that this was done over hours or days or weeks, before the electronic trading. But now it's all done in milliseconds, being able to read this information, because this is all happening during these market manipulations that the smart money is doing to us, right? And they do this for a reason. They create a typical response from us retail traders. So here's a down and dirty quick explanation. Okay, so we have two exact same bars here. We don't know anything about these bars, which is again is something we talked about in the trade room today. You notice I don't show you a bunch of static charts, where I just take a chart, a trade room chart, and I scroll backwards and I say, oh, look, we had divergence here, and look, price went up. I won't show you that, because a bar doesn't mean anything unless you know how that bar was formed and what it took to form that bar. You may have tried trading systems that looked great in a webinar that you saw a guy's chart, and he scrolled around and he said, oh, look at this, and here I took a trade here, and you go, oh man, this looks good, this looks great, this is very compelling. And then you go in the trade room and you try to trade his stuff, and you go, well, I can't make this work. Why did it look so good? Why did it look so compelling? It's because static charts don't tell the story. Static charts are just a minor piece, and it's kind of like smoke and mirrors. So even though I get requested to do that a lot, even by my staff here, they would love for me to show static charts because they're very compelling. But to me, it's not the true story. Things like this is going to tell you a better story. So we got two separate bars here. They both look identical, but something very different happened. When this bar opened, I know there's a tail here, ignore that. When this bar opened, it pretty much went from the low of the bar to the high of the bar without much really going on. Mostly just a lot of buying going on. When this bar opened, it started out and it took off. And it went up to pretty much near this high of the bar. And then all of a sudden, there was a lot of buying going on. And then all of a sudden, the sellers were sitting there like lions waiting in the grass. And price hit a certain area, and bam, all of a sudden, the sellers are jumping in. And the buyers who have been here in this bar pushing, trading. Suddenly, prices moved a long way, and they're like getting a little tentative. It's like, okay, it's time to relax. It's time to take it easy, maybe. But the sellers keep coming in, trying to destroy what they did over here, right? They're pushing the price up. So there's a churning action. This is really important. If you want to think about it this way. A couple of fighters slugging it out. Thing is that this fighter this is maybe his third fight of the night. He's trying as hard as he can, but he's tired. He's already given it all he has. This guy's just been sitting on a bench waiting for his turn. He's all rested. He comes in to fight the other guy who's already been very busy fighting all night long, and he makes short work of him. Okay? Think about it that way when you think about what's going on inside these bars. Okay? This is what we're looking for. I get people that ask me, why don't you read volume? Well, actually, I do. I don't have a volume indicator on my charts, but I do read volume for sure, but only important volume. I don't want all of this superfluous information that doesn't help me make decisions. You know, it's information and it's good information, but I only want particular information. So we're going to print just a dot with a number in it when that type of fighting is going on inside of a bar. That type of churning action is going on inside of a bar. Okay? If you've ever looked at volume spread analysis, you may have found things that are very complicated to read and use. I spent a lot of time developing something that was very simple. There are courses out there to teach you how to learn and read volume spread analysis that take better part of a week, so 3 hours a day, to teach you how to read what's going on in the markets using volume spread analysis. Well, some people may have that kind of time. I'd rather just have a signal that said, it's happening now. Right? Same with tape reading. You know that tape readers is been around forever. And originally it was the guys that were reading the ticker tape to try to figure out what the big boys were doing. Well, we still have that information. And it's our time and sales. And you can see these aren't orders. These orders is the level 2 stuff. These can be, when you place an order, you can remove an order. These are actually processed trades that have gone through the exchange. So I studied the time and sales, and then I translated a lot of that information into a histogram to make it easier to see and understand. And so that what I was actually doing and what I noticed when studying was not necessarily the numbers, but how fast the numbers were changing. If I picked up that whether they were small chunks or big chunks, but if I picked up that they were changing quickly, I noticed that when they reached a certain speed, price would stop and pull back. So if you've ever tried to watch time and sales, you may have noticed that it kind of puts you to sleep after about 5 minutes. Although it's really interesting to watch, you kind of forget what's going on and you become hypnotized by watching time and sales. So I couldn't do that. So I told a programmer, hey, I want something that looks like a speedometer. I want to read the rate at which these ticks are coming through. And then show me on a histogram the rate for each bar. And he sends this back. this histogram. And before I even played with the settings or anything, I threw it on a chart and I started looking at whenever I had these really extra high peaks. Then I just looked up and I saw that price did something. Looked up and saw that price did something right after that peak. And it did exactly what I wanted it to do. It was really cool because usually you have this idea about something and you start to study it and it's like, maybe not. This thing worked great. So that became our speed tick indicator. Now I also noticed when I was developing the speed tick that we would have some relative order flow that also caused price to turn. Relative meaning maybe we didn't hit that high speed, but we increased our speed dramatically over the previous bars. And suddenly when we hit that high speed, price stopped and changed. Okay? We're going to be using all of these things in trading divergence. We use momentum and exhaustion, the volume spread analysis, tape reading, divergence. We're looking at relative order flow, but what we're really looking at is a confluence of all of these things or many of these things. You know, I think we can all agree that each one of these in and of themselves you can create, and many people have, create entire trading systems around each of these things. But what we've done is we actually combine them and only take the best of the best. Okay? So this is what we call our bunt trading. Divergence is a very strong part of our bunt trading. So for those of you, confluence is when things come together in agreement with each other. It's especially powerful when we use non-correlated data for this divergence. Confluence. Meaning that they come from different sources. If we used all the same or relatively the same information or sources of information, then we're going to find a lot of easy confluence. But our indicators are based mostly on different sources of information. They're non-correlated. So when you have this confluence, then you can start to develop confidence and consistency in your trading. Okay? So confluence is the key. One thing I forgot to mention, I had it on a chart earlier, I meant to discuss it a few minutes ago. If for anybody that knows about the Trader Planet Star Awards, they're given out every year, and it's a pretty prestigious thing to have been, first of all, nominated, and secondly, to have won or at least come in the top 3 in these awards. And we didn't know until, 2 or 3 months ago that we had actually won some awards. They never told us. People nominated and voted for us, and we never told anybody. We didn't know. We just found out that we were winners of these awards, and so we're kind of blown away by that. Kind of weird that they never told us, but you know, if you go back and you look at the Star Awards over the years, you'll notice that the people that come and go in this industry are not going to be winning these awards. You know, you pretty much have to have been here for a while and been pretty successful and have some pretty happy customers to win these awards. So we're pretty honored to do that, to win those. If you want more information on that, let us know. And they're actually voting on 2017 coming up here soon, I think. We may actually solicit votes for that. We didn't last year, but shoot, might as well this time. Okay, so what we're looking at here is a very typical trade setup for us. We have the very first thing I'm looking for a trade setup. We have strong momentum. That's these bars that are turning colors from dark to light. Okay. So that's our strong push. We're reading that because momentum cannot be sustained. It's going to slow down, and it's going to have to stop and pull back a little bit. So the stronger momentum we see, the higher probability for a pullback that's imminent. Number two, we have an overbought condition. That's that pink outline. Looking for that exhaustion. When you get a strong push like that, strong momentum, and then an overbought condition, we got a high probability that price is going to do something predictable. Then we have our speed tick indicator that tells us that not only have we pushed a long way, but the market manipulators are placing orders and processing orders much faster than the current retail traders are likely able to do. All right, and then we have our ricochet saying that price started moving much faster than it was just a bar or two ago. We have our pullback alert saying that the volume that created this bar is very important because there was a lot of churning activity going on up in here, suggesting that the sellers jumped in and were beating up on the buyers. We have our flash indicator, which is a divergence indicator, and our McDiver, which is another divergence indicator. So we have two layers of divergence here. Just so you know, my trade is right here on the open of this bar is where I shorted it. We also have major resistance and minor resistance that we use as a defensive position. Oh, this is our velocity indicator. And our high of the day or low of the day, those are minor support and resistance. So we have a major confluence of indicators suggesting that this is going to happen. And we have a nice heads up. We don't have to look anywhere else for a trade decision. Let's take a quick look here. These are just some basic trades. I just recorded a few of them. I use this for kind of over and over again. I could do this on any day because it always looks the same. These are not cherry picked. If you were in the trade room today, you wouldn't know. I promise you, I look at these all the time. I know what they are. You probably wouldn't know if you were in the trade room today. You wouldn't know whether this was today or not because our trades always look alike. All right. So look, we have what I show you, just momentum. We have an oversold condition. We're showing that this bar has been manipulated, right? And we have the velocity suggesting prices moved a lot really fast. What I don't have yet is support on this bar. I'm not going to be trading, and I'm going to go over this more on Saturday, so I'm going to kind of breeze through this pretty quick. I don't have any support right below this, so on the open of this next bar, I didn't trade this. So I waited until all of my conditions were in place. Now I have this support behind me. This bar opened with two different divergence indicators saying that the RSI momentum oscillator and the MACD oscillator both are out of sync with price. I don't care whether it's hidden divergence, whether it's bearish divergence, whether it's bullish divergence, what kind of divergence it is. I don't care. You might, and you might find it important, and you might like to know, but when it comes to trading, I couldn't care less. I know that when I have this confluence of events, there's a high probability that price is going to do something predictable. And that's all I need right there. That's my edge. That's it. I don't need to get rich on this trade. I need to place a trade, maybe 3, 4, 5 contracts. Get in, get out, put my money back in my trading account, and wait for the next one. Then price is dropping. Look, got momentum, Got an oversold condition. There's our speed tick. This particular trade didn't have divergence. We don't always need divergence for our trade setups. This particular trade is a speed tick trade setup. Doesn't need divergence. Price drops. This bar opens above my support with the McDiver. Off it goes. This is what we're looking at. Okay, this is what we trade every day. This is what I'm going to show you how to trade on Friday. I'm sorry, on Saturday. Okay, we're gonna go through. I'm going to use this little tool where I can set up certain scenarios and show you the trades. All right, so that's this Saturday. Don't forget, if you're watching this on video and you haven't registered yet, there's your URL for registering. If you're here in the room with us today, you're already registered, so you don't have to register again. All right, so of course we have a special that we're running for this event. By far our most popular package is our VIP package. That comes with every indicator that we use in the trade room. For NinjaTrader 7 and NinjaTrader 8. It comes with a lifetime subscription to our trade room, or unlimited. A license to all future indicators that we ever use in the trade room, ever. Like that Super D you guys saw, that was a relatively new indicator, and all of our VIPs got it for free as soon as we were done with it. We have a mentoring session every Wednesday called our Aha Moments. This is a session that I talk about some of the things I learned along the way during my trials and tribulations of being a failed trader, and then turning things around to being a successful trader, and a lot of the things I learned along the way. So they're called aha moments because they're intended to give you an aha every now and then. Okay. You also get our fast forward training program. So we have a whole training, self-paced training program. We don't just show you a video on how to train and practice your trading. We actually give you tools to do it, to use, and teach you how to use them. Okay, so there's a lot to the fast forward training program, and we've seen a lot of people shorten their learning curve using that program. You also get priority support, and when you become really, really confident that you're very proficient, we'll sponsor you in a Top Step Trader Combine, which is basically a trial where you can get where you can work to get a funded trading account, and you get to keep most of what you get. All right, now if you're ready to do that, that's cool. That's again by far the most popular package. If you want to ease into it a little bit slower, you don't get all of the education stuff, but you do get all of the current indicators. You don't get any of the new stuff that we develop, which, by the way, we do have a new one that should be coming out, I hope, in the next few weeks. It's looking really, really good. But you do get a month in the trade room with us, including all of those indicators listed there. So feel free to go to PayPal and do the 6 months, no payments. I forgot to put the URL. There it is. Okay, good. Lisa's got it there in the chat for you. Go to that page, and she'll, or you can either buy it from that page, or you can contact us at bunt@theintentionaltrader.com if you have any questions. Maybe you want to do a custom package or something. See if Lisa's got something she can work out with you. And that's it. Oh, I thought I had another slide. And that's it. How about that? I actually made, I left 5 minutes for questions. Anybody have any questions for me on this or anything else bunt trading related? Most of the questions I intend to go over on Saturday, but if you've got any questions for me now, I'm happy to take them. I suspect that my associates here were able to answer all of your questions. If you had any, I think it looks like we have a pretty quiet crowd today. All right, no questions? Well, again, thanks for coming. I hope everybody gets a chance to come join us on Saturday and hang out with us on Saturday and bring your questions. I'm going to talk about how we trade and different scenarios for using divergence and our other indicators. And I have this little tool where I can set up certain scenarios. So if you ask me a question, I can actually set it up and say, if you come to a circumstance like this, here's what I do. Yeah, this is all for NinjaTrader stuff, and everything that we talked about is for NinjaTrader. Which I forget that a lot of people don't know that we only develop for NinjaTrader anymore. We have developed for other platforms in the past, and they are so woefully, pathetically out of date or slow or missing things. Our indicators are exceptionally high performance, and it's easy for us to cripple a trading platform like TradeStation. TradeStation was we spent a lot of time and money developing for TradeStation, and we finally just pulled the plug on it because TradeStation could not do what NinjaTrader can do with high performance indicators. So we pulled the plug on that. Same with multi-charts. So we've decided we're just gonna, because we feel like we have the best, we're going to continue to develop for the best for the best platform, and we work real well with the guys over at NinjaTrader. We help drive their development as well. There have been some major changes to NinjaTrader 8 that were driven by some of the things that we're doing with our indicators that they had no idea that developers would try to do. So NinjaTrader 8 has been updated a couple of times based on input that we've given them. So yes, NinjaTrader is the only platform that we develop for anymore. So if you have any other questions, Stefan, just send us an email at bunt@theintentionaltrader.com, or you can actually go to our website and just hit up there's a little chat thing down in the bottom right corner if you want to have a conversation. One of our staff is usually there. Of course, in the middle of the night, I don't think anybody's there, but one of our staff is usually there that can answer questions for you. All right, great. Well, thanks for coming, everybody, and I hope to see you all on either in the trade room or on Saturday. Bye now.